Good afternoon. My name's Don Vivrette. Welcome to It's Your Money. This is the virtual time we're doing this, and this is our first time of doing it as a webinar. So I'm going to show you a couple of slides. If Pete wants to turn on his camera, then he can, and microphone, then he can jump in as we talk through these various slides. There's Pete. And we will go through that in just a minute. But let me show you a couple of slides in terms of things to take a look at and where we're going. Obviously, we're doing It's Your Money today. Tomorrow we'll do It's Your Estate. You've registered, you got a confirmation email back from you, you've gotten reminder emails. Over here in the middle of the page is materials. It's at itsyourmoneyandestate.org. If you go to that page, and I'll show it to you in a minute, you can download all the material that we have today, as well as the material, also the video rather, that we will have after we finish this, because it's being recorded as we go through. You cannot turn on your audio and your video. This is the nature of having a webinar. What you wind up having is well in excess of 100 people, potentially as many as 200 will be on this webinar, which means we can't have all the people talking and cameras and everything else as we go through. Question and answers, Q&A at the bottom of your screen, and I'll show it to you in a minute. There's a Q&A button, and you can send questions or comments to me, and I will be monitoring them. And I will ask the presenters whatever questions you have as we go along. As I said, it's being recorded and it will be posted on the website. We thank you very much for being here. As a note, if you click on the materials part of it, you come into the website for It's Your Money and Estate. You can click on either one of the two, money or estate. In this case, it's money. And here are all the materials that are available to you now. And after we finish the video and get it converted, then we will be able to have that one included also in that location. Housekeeping for you. Depending on the machine you're on, if you're on a computer, desktop, laptop, something like that, over where Pete and I have our picture, there's a little bar. It's very hard to see, but it's like, looks like this thing. If you drag that left or right, we become larger or smaller. We won't know if you move us completely out of the way because you don't want to see us, or you move it the other way because you really want to look at us. We won't know the difference. So move that if you want. I honestly don't know how to do that on many other machines, but I wanted to let you know that. Question and answers at the bottom of your screen. We're not using chat, which we did in the spring when we did It's Your Money for Laguna Beach, because that was a much smaller group. This time we're doing Q&A. And so when you click on that, you bring it up and send me the note, and I'll be happy to pass that information along as we go. The schedule as we go through this, obviously we're doing the introduction and it's the money test and tax update. Next week it'll be annuities and mutual funds, and then on through the weeks. When you get your reminders, which will be the day before the session and an hour before the session, it will give you the titles. So if you're looking at it on Monday afternoon at 1:30, and you see it and you go, I don't really need mutual funds, feel free to skip it. Remember, these are all recorded, so you can come back to them anytime you'd like. In the past, we were at various locations, so we give a shout out to our normal physical locations, if you will. They're all there in terms of organizations that we would normally be at, except now we're here at a virtual world. These are all the charities that are participating with us. Other weeks, we will have a 3 to 5 minute video on various charities, nonprofits who gave us videos. I do want to give a shout out to Chapman University. For 10 successive years, they've been supporters of us. So I want to give them a bit of a special shout out for it in terms of what's there. Boop, 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 boop. Go there, go there. So welcome to Pete and I. So Pete, I'm going to hand this off to you.
All right.
And you get to go from here.
Thank you, Don. I see Don's photo. Mark, why don't you go ahead and pop yourself up? And hi, Mark. Mark is going to be presenting with me today, and attached will be his Ask First form and his bio. But first of all, before we get into the tax issues, I want to give a brief introduction to the program. Many of you have already heard this, so I don't want to bore you, but we're sponsored by charitable organizations. And the reason why we're sponsored by charitable organizations is that it's good to give. And the charities have the same interest that you do. They want you to be as wealthy as possible and to take as good care of your money as possible, for the possibility that they may receive some, and depending on your goals and your mission. But before you can donate to a charity, which I found that you need to know a little bit about money. And where do you learn about money? I learned about money from my parents, and basically, because we're Dutch, is don't spend any money and save as much as you can. And that was about it. Didn't learn anything about the financial services industry. And yet money was such an issue in our family. When my grandparents died, the family split up. I see, nations go after each other because of finances and money, oil as an example. How different cultures treat money, how different families treat money. I think death and money is probably the two most difficult areas to discuss. And what I find is that if you go and seek to learn about money, then it's usually from a person who's trying to sell you something. And how can you learn about money if somebody's trying to sell you a product? So we have no for-profit sponsors whatsoever. All of our sponsors are charitable organizations, and none of them are for-profit. All of our speakers that you're going to be presenting are, and we're going to get into more detail on this, but they're fee-only fiduciary advisors. They do not sell any kind of a financial product whatsoever. This is all about you getting something out of this program, and I'm hoping that doing it virtually, it comes across as well as we did it in person. We're now on our 25th or 26th year of doing this. So, and it's grown immensely. And so I hope this is all about you. Hope you get something out of it. We encourage you to do the Q&A. We're going to have these sessions recorded, so you can go back and review it if you missed something. It has an immense amount of vocabulary, and so it's not the regular vocabulary that you talk about day to day. The more literate you become financially, I think the happier you're going to be, the more comfortable you're going to be, the more in control you're going to be, the longer you're going to live. And that's the goal. So what I'm going to start in right now is because we're going to have a lot on our plate, I'm going to ask Mark to start in because taxes play such a large role in our financial life. I'm going to have him start with giving us a kind of an overview and review of the tax laws there are today and some of the important factors that we need to know when we're taking care of our own money. Mark, why don't you take it away?
Thank you, Pete. See if I can get myself to full screen here.
You got it.
That should work. Good. Well, it is my pleasure to be here. My name is Mark Prendergast. I'm a certified financial planner. I'm also a CPA and have a few other designations too. So my title here at Inspired Financial is Director of Tax Strategies. What we do at Inspired Financial is we do comprehensive financial planning predominantly for women in transition, widows and divorcees, widows and divorcees predominantly. So I'm happy to be here at It's Your Money. I've co-presented with Pete at a number of the sites, Huntington Beach, Costa Mesa, Irvine, Newport Beach. So it's a pleasure for me to be here and always fun to work with Pete. So here's the agenda. I'm going to kind of roll through making tax-wise decision-making, The second one, actually income items is not on here. I forgot to delete this part. I updated some slides. So, but we're going to talk about a lot of income items anyway as we go through here. I'm going to talk about itemized deductions versus standard deduction. And then we're going to get into IRAs, required minimum distributions, some things that happened with the Secure Act and the CARES Act. And then we'll talk about some miscellaneous things, the state taxes and property taxes. So for starters, I want to encourage you to be tax wise. And being tax wise, one of the most important things you need to know is what tax bracket you're in. This is a big table, but let me circle around. I don't know if is my cursor circling around things, Pete? Can you see that?
No, I don't.
How about over here?
Oh, yeah, now I do. Yes.
Okay, I have two screens. I'm not sure which screen is showing. So I'm going to first start just by example, married filing jointly if you're a married couple. If you're single, you're going to be over in this column. But to be able to know what tax bracket you're in. So for example, I have the 22% bracket. And if I look at married filing jointly down here, that 22% bracket is taxable income basically between $80,000 and $171,000. That is a big, big bracket. That's a lot of room to move. And so being tax-wise, number one, what bracket are you in? Look at on your tax return, what does it say for taxable income? That's for starters. And then the other is, as we go deeper, is how close are you to the edge of one or the other? If you are near the bottom of that bracket and you get some deductions, you may push yourself into a lower tax bracket. Or if you're towards the top, you may be staying in the same tax bracket. You want to know what your deductions are doing for you.
Mark, if you're in a 24% income tax bracket, and does that mean that all my taxes are taxed at 24%?
That's a great question, Pete. No, you get to do the stair step. So your first 19,750, nearly 20,000, gets taxed at 10%. And again, I'm focusing on married filing jointly. Next, from 20 to 80 in round numbers, you're at 12%. 22%, you get benefit of that. So you just stair step your way up, but you do get benefit. It's not like you cross a threshold and everything is taxed at the higher bracket. You've just moved into a higher bracket for the incremental amounts.
And Mark, when you talk about the tax brackets, is that AGI?
No, the tax brackets
First of all, what is the definition of AGI?
Good question. AGI is adjusted gross income, and that's predominantly all of your income items, and you get to offset a little bit with some retirement plan deductions for the most part. That's basic as I can get it. But AGI, adjusted gross income, is your gross income. Your taxable income, which is what we're focusing on this table, is after your either standard deduction or your itemized deductions.
So this is a must know. People should know, like their birth date, they should know their income tax bracket.
Yeah, sometimes it's hard to remember our birth dates, but especially our children's, because, well, their age, it keeps changing. That's another story. So yes, you should know your tax bracket because that is meaningful when you start making decisions. Right here, I look at it and I go, oh, wow, it's a big fat table. I'm not sure. But as we move through here and we talk about certain income items and certain deductions, then I hope it's going to become more real to you.
Especially why is it important? Because it's coming to the end of the year.
Right. And at the end of the year, that's when we tend to make our tax decisions, such as, do I want to make a large charitable contribution? Do I want to bring in some income? Do I want to defer income till next year? So we have
Do I want to take money out of my IRA?
Do I want to take money out of my IRA? Do I want to realize some capital gains? Maybe my portfolio is out of balance. My US stocks are too much of my portfolio because it's done well over the past 3-4 years, and maybe I need to be more in bonds and I want to be more conservative. Well, if I sell those stocks, I may be incurring capital gains.
One of my experiences been with individuals is that this is the least amount of focus most people give to their financial affairs, and that is their tax issues towards the end of the year.
Correct. So I'm going to move on to capital gains brackets. So those are very different. And we see here, they tend to be more favorable. If I look over here what the rates are, it's either 0, 15, or 20. And so your 0% capital gain bracket If your taxable income, that's what these numbers are, if your taxable income is under $80,000 for a married couple, your tax on capital gains is zero. So sometimes you might go, oh, my taxable income is $74,000. That's what it looks like it's going to be. This is part of planning. You do your tax return and find out it's too late once you're doing your tax return.
Would you say capital gains? Is that short term or long term?
That's a great question. That would be long term. And capital gains, when I talk of capital gains also in this context, includes what they call qualified dividends. So long-term capital gains, you held the asset for more than a year, a mutual fund or a stock, and you sold it and you had a gain. That's a long-term capital gain. A qualified dividend, usually you're going to see those coming. If you own individual stocks, those usually are all qualified. Qualified means it's qualified for the special capital gain rate. Also, you'll see them in mutual funds. For stock mutual funds, those will also issue qualified dividends. And a qualified dividend just means one that's paid by a company. It's a dividend by a company, as opposed to a bond mutual fund holds a bunch of bonds. Well, that's interest income. That's not really a dividend from a company.
And then when you go through this, where it's married filing jointly, 0 to 80,000, that's based on your taxable income, not on the capital gain. The
Correct.
rate would then, if it's the 15%, if we were in 80 to 496, it would
Correct.
then be that rate times your capital gain. But this is set based on your taxable income, not the amount of the gain.
Correct.
And these are subject to change whenever the law changes, not every year.
Correct. That's true. And also, if you end up crossing a threshold, for example, your taxable income is $70,000 and I bring in $15,000 of capital gain, then the first 10,000 up to 80, I'm still going to get tax-free. The next 5,000 of that 15 would be taxed at 15%. So if you're below it and you go a little bit over it, you aren't damning yourself. You're still getting benefit of the 0% capital gain rate.
So if somebody's putting together a portfolio, you're going to focus in on how to get capital gain income versus ordinary income.
That many times that's a focus.
Okay.
Capital gain has better tax results. Qualified dividends do. Ordinary income, like from bond mutual funds, less, except bond mutual funds, as you do asset allocation, your bonds, it's very important ballast. It's what holds that ship kind of level as it's going through some rough seas. And we've seen a few rough seas. So we'll kind of move over to standard deduction versus itemized deductions. It used to be, I'll say most of us, not most people, but most of us, and probably most of the audience, used to be able to itemize their deductions because they would take their state and local income taxes and their charity and other things. And if you see 2017 and before, for married filing jointly, the standard deduction was $12,700. You get to deduct whichever's higher, standard deduction or your itemized. And often we could exceed that just with our home mortgage interest and property taxes, we'd be over that. These days, a lot fewer people are itemizing. The standard deduction is now $24,800 for a married couple. And if both of them are over age 65, each one gets to add $1,300 to that standard deduction. So if that couple 65 or older, it's around 27, a little over 27,000 is their standard deduction.
So let me use an example. If my spouse and I, we made $100,000 this year and we have no deductions at all. So what would be our adjusted gross income?
It would be $100,000 as your adjusted gross, because that's before these deductions here.
And then we would be able to take and reduce our income by $24,800 for tax purposes?
Correct.
Okay.
So in round numbers, your taxable income would be around $75,000.
Okay.
So as you can see, they almost doubled across the line, married filing jointly and single, head of household. That's why most people now, it's probably well over 80%, maybe over 85%, are taking the standard deduction. We're finding that a lot more in our clientele. And as we go through this, actually, let me dive into the itemized deductions.
Mark, before you do that, let me ask, there's one other question. there seems to still be some confusion about long-term and short-term capital gain. Short-term capital gain, is that taxed as ordinary income effectively?
Yes, it is.
Okay.
Although there is a netting process. You say, what are my net short-term my net short-term gains and losses? And you come up, you either have a net short-term gain or a net short-term loss. You net your long-term gains and losses to come up with a net, and then you net the short and the long, whichever one is bigger, rules. And
In other words, play the tape back when we're done with this and listen over and over to what you just said, because that seemed a little confusing. But let me ask you another question while you have this slide up. HOH, head of household?
Yes, head of household. Yeah, pardon me for skipping over that. Most of the time we've presented to seniors, and maybe there's a lot that aren't seniors here, especially since we've gone virtual. And so most seniors don't qualify as head of household because you have a dependent child in the house.
And the $1,300, is that per person? So if I'm married and I'm over 65, because I noted Pete didn't ask you about the $1,300, even though he's well over 65. Is that $1,300 each? And do they both have to be over 65?
It's $1,300 each for each one that is over 65. And I know that Pete is, but I do not know about his wife. So I'll just stay with
25.
And head of household is you're not married, but you're taking care of children and other things. Therefore, you're defined as the head of household.
Correct. Right. Yeah, you're basically single, unmarried, and you have a dependent child in the house. There are some rare exceptions where you can be married but separated and still be head of household. But you got to follow those rules and beyond this discussion.
Thank you.
Sure. So what are itemized deductions? They fall into 4 categories, and I have the 5th one lined out. It's an old one that doesn't exist anymore, but medical, you have to exceed 10% of your adjusted gross income before you get credit for any of your medical. So a lot of the medical deductions just go away non-deductible. State and local taxes, this is a really big one, especially in California, that the acronym is SALT, state and local taxes, SALT, and it is limited to $10,000 per tax return. So if you're single, you get 10,000. If you're married, you get 10,000. If you're married, you do not get 10,000 each. You only get 10,000. That's severe, especially in California, where and especially coastal California, Southern California, where your property taxes alone might be $8,000 to $20,000 and beyond. So all of a sudden you're limited to $10,000, not only your property taxes, but your income taxes, which you pay the franchise tax board, and your car and boat taxes. Part of your DMV fees are in theory deductible. Most of us, we just look at that and we go, oh, well, it's $10,000. I don't care what I paid, it's $10,000. That's what that limit is. So there's a floor. In our financial planning circles, the most successful retirees have no mortgage interest. So that's one of the things we try to plan for, is that they're debt-free. They like being debt-free. So if they have no mortgage interest, then they almost always are going to be taking that standard deduction. But for those of us that have a mortgage on the house, you get all of your mortgage interest up to loans for $750,000 or more for any loans initiated post 2017. If you have an old loan, like $1 million loan that was from 2005, 2008, whatever, you can still deduct all the interest on your own old loan if it exceeds $750,000. That was a change in the law, the end of 2017, effective 2018.
Mark,
yes.
Can you still take a charitable deduction if you take the standard deduction?
The general rule is no, but I believe it was the Secure Act. It was CARE Secure. It was the Secure Act gave us an above the line deduction for $300. I mean, I'm just not sure about all the social engineering that went behind that, but a $300 deduction just doesn't give that much juice. I think it's just political window dressing, but I'm getting political here. But generally speaking, you can't unless, and we're going to talk about making donations out of your IRA, which is a way that you can actually get
Okay, let's go to the next slide.
Okay. I'm going to make a last comment. Miscellaneous deductions, 2% of AGI. Those went away, except in California, they're still valid. So it's still worth going through there for your California return. Those would be investment advisory fees you pay a firm like us, your tax preparation fees, work expenses, unreimbursed work expenses, those kind of things. So still deductible for California. And I see that a lot of times people miss that.
So, okay, for California, we're not going to go into California income taxes, but for most people with a $60,000 worth of income, you're going to be somewhere between the 6 and 8% income tax bracket. Is that kind of a generalization, correct, Mark?
Right. I'd say that's a pretty fair number.
Okay. So keep in mind that taxes, because we don't talk much about California income taxes, it could add another 5 to 8%.
Right. And if you're in higher brackets, it's almost always 9. I mean, you get above probably 80 or 90,000. It's flat out 9% up to until you get to $500,000, and then you may move into 10 and beyond up to 13.3. Just a brief discussion on 529 plans, and this was from the 2017 Act. It allows for 529s, those are savings devices for college. You put money in for your kids or grandkids, and if they pull it out for qualified expenses, the income is tax-free. You never get a deduction, not in California, and not for federal. You don't get a deduction for putting money into the 529 plan. And when you pull it out for true education purposes, it comes out tax-free. So basically the growth is tax-free. So they changed it to allow kindergarten through 12th grade withdrawals for tuition only for private school. I would never recommend a client do that. Really, you want to save it for you want to get as much, the longest period possible so that you can have the most growth possible so that you can afford what college is going to be. And presumably college is going to be more than high school, or if they're in a private school, college could be the same as high school. But
and by the way,
you want time on your hand. The other thing about these withdrawals is for California doesn't allow it. So you end up getting penalized if you pull money out of a 529 plan for these K through 12. So I just say, the law says you can do it for federal, don't do it. It's just not good financial planning. And the other thing is you can actually super fund. You can put up to $15,000 a year, but the government allows you to do 5 years in advance. So you could actually do $75,000. And if you had a married couple, you could put in $150,000 in total per child, grandchild.
What I see a lot is that grandparents want to do something for their grandchildren, and this is what I recommend to them on many occasions, that they could fund their grandchildren's higher education through this kind of system.
Yeah. So I want to save some time for Pete, so I'm going to start moving through these things a little faster if I can. So Medicare surtax tiers, this is one of the things that concerns me when I do tax planning. Whenever I want to say, oh, a client is in a low income tax bracket, I want to bring some money in, bring some income in to pay at cheap rates. So if I bring in income and I make my adjusted gross income, this is modified, we can just call it adjusted gross income. If you increase it too much, then you may be paying more in your Medicare premiums 2 years later. So, and there's a reason for 2 years later. You file your 2018 return. When do you file it? You file it in April of 2019 or maybe in October of 2019. The government really doesn't know. They can't adjust your 2019 Medicare premiums based on 2018 because you haven't filed your tax return. So they say 2018, what happened? 2019, they'll figure it out. And 2020 is when they're going to charge you. So as your income goes up for joint return, you can see if your income's above 218,000, for example, you have basically doubled your Medicare premium. And if you're a married couple, it's double on both of them. So whenever you talk about bringing money in for tax purposes, for strategic reasons, we always try to be aware of that fact. Secure Act provisions. This is what passed the end of last year. It increased the required minimum distribution age from age 70 and a half to age 72. So required minimum distribution says once I reach a certain age, and now it's 72, the government says we let you defer and pay no taxes on that IRA or a 401k for all these years. At some point, you have to start paying taxes on it. And they say that's when it is. Now it's age 72. You have to start taking it out according to a schedule. I think it's a pretty fair thing. They give you a good deal. Everybody gripes about it on the back end, but they give you a good deal to save all your time. So when you have to pay the taxes, just be grateful you live in this country, I think. Huge change here is for inherited IRAs. So there's no change for spouses. Spouses can still take their deceased spouse's IRA, roll it into their own, and now they have a spousal IRA or a survivor's rollover IRA. It rolls over tax-free, and that spouse can then take it according to their own schedule. They aren't forced to take it out any faster than they normally would have to. Non-spouse beneficiaries, that's where the big change came in. There's no more lifetime stretch. You can't give it to a 2-year-old and find out that they have a 74-year-old life expectancy and stretch it out over that time period. The new rules are if the IRA goes to a natural person, you have a 10-year stretch. So if you had $1 million IRA, that's going to be, in round numbers, $100,000 a year. You are not required to take anything out in any particular year, but in year 10, whatever's not taken out, you have to. So that's where tax planning comes. How do you strategically take it out, minimizing your tax over that 10-year period of time? If it's a non-natural person, such as a trust that is the beneficiary of the IRA, you have a 5-year rule. And so that's, again, you can take it all out in year 5, but trusts have the worst tax brackets. There are some see-through trusts beyond this discussion here.
Mark, just so you know, we're going to go through the entire IRA area in the each of your state section. We're going to spend an hour and a half on this area. Okay. It's complicated.
Good. The CARES Act, which passed, like I think March this year. Old news is the filing deadline change and our estimated tax payments change, but that's all July 15 and before, so no need to comment any further. The big change was, they said, the required minimum distribution for this year. You pull out that schedule, see what the IRS says you have to take out. This year is a free year. No IRA distribution is required. So all of a sudden, we have lower income. Those who had $1 million IRA, maybe they had to pull out $60,000, $70,000 of income. This year they don't. So their income is going to be lower. They may be in lower tax rates. So they may be paying lower taxes.
And Mark, let me ask you a question.
Sure.
Back where the slide before, you don't need to go back to it, but it relates to this on the RMD. If someone, my mother died in 2007 and my father died in 2015, and they have inherited IRAs, that's not affected by the change of law, is it?
Correct, that is not.
They're in place.
Right, any of those old inherited IRAs, you still go by the old stretch rules.
Thank you.
Yep. So during this year where we have a possibility of having lower taxes, maybe I want to bring some IRA. I don't have to. Maybe I want to bring some in. Maybe I'm normally in a 32% bracket, and now all of a sudden I'm in a 24% bracket. Maybe I want to bring in some income into this year. Maybe I want to do a Roth conversion. I'm going to talk about that a little later. And again, I always give this warning. What does it do to your Medicare tax? Whatever income, a Roth conversion or pulling money out of an IRA is going to increase your income. Roth IRA and Roth conversions. What is a Roth IRA? Pete's going to go into that a lot more later, but not today, in other sessions. But basically, you have after-tax dollars that you've put into an IRA. It grows tax-free. It comes out tax-free if you're age 59 and a half or older. And we always assume you're going to be age 59 and a half. Nobody likes to pull money out of the Roth IRA. If they have to, they've either hit a calamity or they're just poor money managers. So what's a Roth conversion? A Roth conversion says I have a traditional IRA or a 401k, and I'm pouring that money into a Roth IRA. What I do is I pay taxes on the value of the assets transferred. If I $100,000 of my traditional IRA, put it into the Roth, I've increased my taxable income by $100,000. I've taken the tax handcuffs off of it. These assets now grow tax-free, and withdrawals will be tax-free. So these are really critical. So if you're going to go back and review the slides and you're thinking about a Roth conversion, these are really critical questions to ask. what's your tax rate this year and what do you think it's going to be in the future? This year, artificially low. This will reduce your future RMDs. If you do a Roth conversion, you're reducing your traditional IRA. Your traditional IRA balance at the end of every year, that says how much you have to take out the next year. If you've lowered the balance, you have to take out less the next year and all years after that. Will you use up all your IRA during your lifetime? Maybe the way you're going, you're going to die with a big fat IRA and you're going to stick it on your kids, which they are not going, they'll be grateful for it, but they won't like the taxes. So the next question is, what about your children's tax brackets? If your tax bracket is 22 or 24% and your child is a physician and you know that she is in the highest tax bracket, you may go, a gift to them would be for me to be paying taxes in 22 and 24, maybe even 32% brackets. I'll pay it. When they inherit my Roth IRA, they're going to get it tax-free. This is another key one. If you're married, once one of you checks out, that's a euphemism for dies. Once one of them checks out, will the survivor be in a higher tax bracket? Probably so, because the survivor is going to find out their standard deduction is cut in half. Less deductions means higher taxable income. The tax brackets are compressed, so they're going to move into higher tax brackets at lower income levels. So that surviving spouse may have that same IRA income in and maybe the same pension income and other assets. So all of a sudden they're paying a lot more in taxes. And so maybe it's wise while both are alive to start nibbling away and taking Roth conversions at $10,000 or $20,000 or $30,000 a year, knowing what bracket you're in. Maybe you want to fill up your bracket. And the two negatives I haven't read. Is a charity the beneficiary of your IRA? If a charity is the beneficiary, then generally you don't want to be doing Roth conversions. The charity is going to get it tax-free. Why do you want to pay taxes on it? So just leave it alone. And also, as I say, beware of those Medicare premiums increases. Otherwise, they call them IRMA tiers, and I won't go into.
Yeah. By the way,
IRMA stands for.
You know that commercial where they do a speeding car and they say, "Don't try this on your own." This is kind of what I feel on this conversions. Do not do this on your own. Get together with a professional. You've got some good questions to ask. Got to have a discussion. There is no one right answer for everyone.
Yeah.
And a question mark that's come up on that. Can you do a Roth conversion in 2021 before April 15th and have it count for 2020?
No, you can't. Roth conversions are bound by the calendar year that the transaction happens.
Thank you.
That's a good question, though. So touch on estate taxes just a little bit. We have a lifetime exclusion of 11.58 million per person. So a married couple over 23 million that you can give your accumulated assets down to your kids and grandkids tax-free, estate tax-free. This provision expires in 2025 or when Congress changes the law. We have a vote, a presidential election coming up. And so this number could change very drastically next year. Just giving a warning there. So when the first spouse dies, you should always strongly consider electing something called portability. And maybe you can Google that and read up on it, but it's basically a person dies, and when I die, I have the ability to give assets worth 11.58 million down to my kids. And if I don't, if my executor doesn't, or if I don't, then that's unused. Well, that unused part I can give to my wife. I can't do it. She has to take it herself, but that's her job. She's the one living. She's the executor of my estate. So she's able to take that 11.58, add it to her own. That's how we get up to this $23 million. My 11.5, her 11.5, all subject to the election that's coming up.
Let's go to the next slide, Mark.
Okay. Prop 13 and more. So all these spin off of Prop 13, most of us know that it limits the increase in our property taxes at 2% per year. Prop 58 says that my kids can take my property tax basis if I either gift it to them or I give it to them when I die. If it's my personal residence, they can step into my shoes and keep paying very low property taxes. If it's a non-residence, if it's a single family residence that I'm renting out, up to $1 million, the person, whoever inherits it or gets gifted, they can step into my shoes and keep the low property tax on that. Proposition 193 said it also allows going to the grandchild if the parent is predeceased. So if my child has passed away, my grandchild can still get benefit of this Prop 13. Prop 60 is another one for those of us that are living, even more importantly, age 55 plus. If you move within the same county, you can transfer your property tax basis, your assessed value, as long as you're buying equal or lesser value. So it's like you're downsizing. And here's a warning. I find so many people going, yeah, we're going to downsize. Yeah, we're going to downsize. And they go shopping and they found some place. They moved from, 3,000 square feet to 2,100 square feet, but they're fighting the values because they want to move closer to the coast and blah, 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 blah. And so they really didn't, they downsized by size, but
Not value.
then they got to work it. We got to work the value. There's a little bit of wiggle room. Within 1 year, it can be 105% of your old selling price. Within 2 years, you have to do the deal by the end of 2 years.
I find very few people taking advantage of Prop 60.
Yeah. And you can't, the general rule is you cannot cross county lines with that. The county you're moving to must accept that. 10 counties do allow you to move across county lines. And it does include Orange County, LA County, and San Bernardino and Riverside counties. So those are.
Let's go to the next slide.
Good idea. I have 3 planning strategies.
Yeah. Could we go? I want you to go ahead and skip that.
Okay,
Well, we're going to discuss this in the charitable session.
good. And this is another one, qualified charitable deductions.
Yeah, we're going to talk about that in the charitable session.
Okay, I'm just gonna make the comment, this allows you to reduce your adjusted gross income. Whenever you do that, good things happen. So, read the slide and just know that this donating out of your IRA is a very good thing, very tax efficient.
Very much.
And then I have a Roth conversion here. Do you want me to go through this, Pete, or would you like to just?
We're going to go through that in the retirement IRA session.
Okay, so I come to the recap. Know your tax brackets, what happens to ordinary income, know what happens to capital gains, and we race through some tax strategies that you're going to find out a lot more about in detail.
And by the way, you have your email address on your, there you go. If you have any questions whatsoever, Mark, can they give you a call or write you an email?
Absolutely. And just mention, maybe in the tagline, put "it's your money" in the top so that, you might go to spam for all I know, but it's hard to figure out. You don't want
145 calls immediately.
Right, there you go. Yeah, I am happy to answer any questions though.
Okay, let's go to the quiz.
Okay, you're asking me to operate this thing.
Yeah.
Right?
While you're figuring that out, we have a question in terms of Prop 60. That benefit can only be used one time, correct? Not once at 60 years and again at 75? Just once?
Yeah, it can be used only one time in a lifetime.
Thank you.
Okay. Don, are you going to put up the polling?
Pete, I'm going to make a suggestion. Since
Sure.
you have 15 minutes to go, I would suggest we skip the polling and talk about it.
Okay. Which of the following is the most liquid assets? I choose mineral water. Liquidity is just absolutely important. So bank savings account, 0 to 6 months, keep it liquid. Real estate is not liquid. Having your money tied up in a real estate or a gas partnership is not liquid. You need some liquidity. It's very important. The older you get, the more liquidity you would probably like. Number 2, why are women more rational, better when it comes to managing money? More cautious, the financial services industry caters to men, do better research prior to making the decision. All of the above are true. And Ruth, RBG just recently died, and she made it very clear that, women couldn't even get credit cards or are qualified for a mortgage. So the financial services industry is very, very much catered to men. Men make more decisions rapidly and more intuitively, and most times they're not correct. So that's why women are better money managers. They make less changes. Number 3, the Securities Investor Protection Corporation was chartered by Congress to combat fraud. False. It wasn't designed to combat fraud. It's like Alan Greenspan said, fraud is normal. That's not unusual. It's to combat theft. So the question is, did Bernie Bainoff commit fraud or did he commit theft? It's still being argued. They haven't decided. Number 4, what are capital gains? And we just got through going through that. It's D, a profit resulting from the sale of an investment such as stocks or real estate. To have income from capital gain, just think, you can have up to $75,000, $80,000 worth of income and pay 0 in taxes. We focus way too much on earning ordinary income. We should be focusing on wanting to gain capital gains. Number 5, insurance agents are required by California law to be compensated through commissions. It is true. By law, I cannot hire an insurance agent and pay them by the hour. Why do you think that is? If you're a CEO of an insurance company, what would you like your insurance people to do? And that is sell product, okay? There's enormous amounts of commissions in insurance products. What is the difference between a no-load mutual fund and a load mutual fund? It's D. Load funds charge a fee and a sales commission on investment transactions. We tell you and recommend highly avoid load mutual funds. And we'll go into more detail in next week's session. There is no reason to pay a load. Number 7, for a married couple, probably the best method to hold title to property is joint tenancy with right of survivorship. That is false. It is best for a married couple to hold title either in their living trust or as community property. And it has to do with a tax law. When the first party dies, you want a full step up in basis. We're not going to go into the detail, but that's kind of what the It's Your Estate program is about, going primarily how best to hold title to assets. Number 8, when you set up a bank checking account, you should ask about minimum deposit, restrictions, number of locations, and many, many other questions. It's all of the above. When you go into a bank, you're going into Macy's, you're going into Nordstrom's, you're going into Gelson's, you're going into a store, and they're going to want to sell you stuff.
Do they still give you toasters?
No, they used to.
I know.
I haven't seen any gifts. They're getting pretty stingy, okay? But it's, be careful, okay? Every person in the bank is on some sort of an incentive program. Wells Fargo wasn't the only bank that had those kinds of incentives. So be careful. Most people after the age of 65 will need nursing home care. And I've seen now about 20 years of my audience, and it's got to be true. Not really, okay? It is true, but the more accurate a statement is most people after the age of 65 will need nursing home care for 3 months or less. When you're 85, you'll have, the answer would be for 3 years or less. Where are we? Given the choice between saving for retirement or saving our child's college, most financial planners say you should, what is D? I don't see D down there. I think it's B. Save for retirement, your children have more options for paying for college than you will have for retirement income. And what the reason why I put this question in is that, you know, like when you're on an airline and they say the mask comes down, put it on yourself first and then put it on your children. And this is the same thing. Worry about your retirement first, and then once you're secure, then you can worry about your children. Let's go to the next question. Key issues to review before investing are time horizon, cash flow needs, risk tolerance, future income requirements, your tax situation. If you don't do this, it's all of the above. You're not doing a good service for yourself. And I find most individuals do not look at their tax situation first. They don't look at their future requirements. Men hear about a particularly good deal at a cocktail party and may invest, but you really should look at these issues before making any type of investment. Number 12, cash is best when donating to charity. False. Although 95% of individuals give cash, capital gain investments are the best. Things that you might have had for 20 or 30 years that have an enormous gain. You get an income tax deduction from the market value, and you've only paid a smaller amount. When we get into the charitable session, we'll go into more detail. 13. Warren Buffett that said that the use of a financial professional can detract from you achieving financial success. And the answer is an absolutely true. The reason for this is that most individuals who are in the financial services industry are in the business of selling financial products, who make a living based on commissions. Paying huge sums on commissions and fees is detrimental to you achieving financial success. Number 14, typically people pay less federal tax once they retire, but with federal debt so high, it's quite possible tax rates will rise for all Americans, including future retirees. Given the uncertainty, should you invest in a traditional, a Roth, or a 401k? And the answer is, it depends. Before you make these kinds of decisions, you should sit down with a CPA to discuss what is best for me, or for a tax professional. If you're making very little income, then a Roth IRA is probably the best, because you don't get that kind of deduction. Let's go to 15. Historically, real estate, especially home ownership, has produced a better than average annual return than stocks. And the answer is false. Long-term average return for stock prices is about 10%. Home values have increased traditionally long-term approximately between 3 to 4%. Although if something like, one of the things we were at the last session called Money in Your Mind, and they talk about recent phenomena that's true. And if you sold a recent home here in Southern California, you would absolutely believe that the best thing to do from an investment point of view is to purchase real estate. Number 16, when investing, it is important to work hard, follow your instincts and have fun. This is absolutely false. Investing should not be hard work. And the last thing you want to do is follow your instincts. And it should not be fun. If you're going to have fun with your money, put aside $20,000 or $30,000 into an IRA account and then start investing. And after 5 years, see whether or not how well you have done compared to putting it in the market in a what we call passive investments and seeing where that investment is in 5 years. 17, an investment portfolio's growth is driven by how much you save, how long we invest, investment performance, and investment cost. And the answer, of course, is all of the above. But I want to focus on 2 things. One is how much you save and investment cost, because investment performance we have no control over. And don't let anybody kid you that says to you, I can outperform the market. We got 5 minutes. Thank you, Don. Suppose you have $100 in savings account earning 2% interest. After 5 years, would you have more than 102, exactly 102, or less than 102? You would have more than 102. 19. Imagine that interest rate on your savings is 1% a year and inflation is 2%. You would have less than today. Number 20, if interest rates rise, what will typically happen to bond prices? They would fall. Number 21, a 15-year mortgage typically requires monthly payments, higher monthly payments than 30-year, but the total interest paid over the loan will be less. Absolutely true. It's just amazing, the numbers. It's almost like compounding in reverse, but it's a debt. Buying a single company stock usually provides a safer return than a stock mutual fund. That is false. Number 23, a financial advisor registered with FINRA is legally obligated to serve in your best interest. It is false. Question number 18 to 22, those 5 questions have been given to about, close to 700,000 individuals. And those individuals, 700,000 individuals, the correct answer was 3 out of the 5, basically indicating that we have a very low financial literacy IQ. And because of that lower IQ, we're susceptible to more scams. We don't know who to trust. More than likely, you should give this exam, the last 5 questions, especially to your children. And if they score less than a 3, maybe you shouldn't give them any money upon your death. They may not be able to handle it. So as we go through these next 8 weeks, we're going to touch upon each one of these issues that we brought up in the quiz, and we're going to expand on them. And so next week, what we're going to be doing is that we're going to talk about that the financial services industry is about selling. And the two most products that are sold, by the way, are mutual funds and annuities. Mark, you got your microphone, turn your microphone on. Are annuities, can you get a
close your PowerPoint, Mark.
Can you do a capital gains tax?
I'm sorry, stop sharing.
An annuity?
There we go.
No, annuities give only ordinary income. Annuities give the worst kind of income result.
Okay, so we're going to be talking about that next week. We're going to be talking about mutual funds next week primarily, but most of all, we're going to talk about how the financial services industry sells you stuff. They just recently did a research program, and they said that $25 out of the financial services industry is spent on financial marketing. $1 out of the industry is spent on financial education. So our program is about financial education. Mark, thank you so much for participating.
Pete, wait a minute. Two questions have come up. One is, what does FINRA stand for? What are the initials?
Find out next week.
And Mark, a question for you that came in earlier, but it didn't fit in. On Prop 60, is that for each spouse or for the couple?
I'm going to say you have stumped the dummy.
Yay! That's the way to end the meeting.
I could only guess, so let me not guess. If a lot of people maybe in Orange County Assessor's Office has a great Q&A in there, and the answer might be in there.
Okay,
on their
excellent.
website.
So Pete, Mark, thank you very much. I appreciate it. Again, this video is, assuming I didn't screw something up like I did once in the spring, we'll process the video that we're recording, and it'll be on the website by a week from now, probably earlier. So I thank all of you very much. If you're doing estates, we'll see you tomorrow. You don't have to do the orientation tomorrow. If you did it today, it's the same thing. So we'll see you tomorrow at 1:30, or we'll see you a week from now at 1:30. And have a good time. Thank you very much.
Thank you.
All.